Welcome to This Explainer. Look, today we're going to completely demystify investment funds for everyday beginners and show you exactly how to make your money work for you. Whether you're literally just starting out or you're looking to refine your strategy, you are in the exact right place to take control of your financial future.
All right, let's just dive right into it. Whether you're a market trader in Legos trying to grow your savings, a student in Accra learning personal finance, or even a crypto investor in Abuja exploring traditional markets, this is the ultimate question you need answered to build your wealth. It's a debate that trips up a lot of people, but we're going to clear it all up today.
Here's our roadmap for today. We'll cover why you should invest in funds, define exactly what mutual funds and ETFs are, put them head-to-head, and finish up by actually building your portfolio. Let's get to it.
Section 1. Why invest in funds? Well, before we look at specific investments, we need to talk about the core problem we all face with our cash.
And that problem? Inflation. It's that silent wealth killer. Basically, inflation is the increase in prices over time, which quietly eats away at your money's purchasing power. Think about it. If you stuff 500,000 naira under your mattress for 10 years, sure, it's physically still 500,000 naira, but its power to actually buy what you used to buy way down. That is exactly why we literally have to invest just to keep pace.
Now, you might be thinking, why not just save? Well, the difference between saving and investing is absolutely crucial here. Saving is fantastic for safety, like Chinedu getting a standard 5% interest rate on his emergency fund at the local bank. But investing, yes, it carries higher risk, but it's how you actually grow your money faster for long-term goals. It's how we combat something like a 15% inflation rate. You really can't just save your way to wealth. You've got to invest. But, okay, here's the catch. Trying to pick one single winning stock is incredibly risky. If that one company tanks, your wealth disappears. Funds solve this massive risk problem by giving us diversification. Instead of putting all your eggs in one basket, you pool your money with thousands of other everyday investors. Then professionals take that massive pool and buy a whole basket of different assets. It spreads everything out and seriously lowers your risk.
Which brings us to Section 2. What are mutual funds? Let's look at the first giant in the investing world. So the easiest way to think about a mutual fund is that it's a lot like a chartered bus from Lagos to Abuja. You and thousands of other passengers pool your money together for the fuel and the journey. And the best part? A professional driver handles all the routing, the navigation, the traffic, while you just sit back and relax. In the financial world, that driver is a professional fund manager who makes all those daily active investment decisions for you.
Moving right along to Section 3. What are ETFs, or exchange-traded funds? Let's see how this builds on the idea of a fund.
All right, picture an ETF like walking into a busy market to buy groceries. Instead of wandering around buying tomatoes, then onions, then spices separately, which takes way too much time and research, you just grab a pre-packaged grocery basket. It already has everything perfectly balanced inside. With one single flexible purchase, you get a highly diversified portfolio. And unlike mutual funds, ETFs trade on stock exchanges all day long, exactly like a regular company stock.
Section 4. Mutual funds versus ETFs. We've met the chartered bus and the grocery basket, so let's put them head-to-head. When we compare their features, you'll see exactly where they differ. Take trading, for instance. Mutual funds trade just once a day, calculated at the end of the day. ETFs, they give you the ultimate flexibility to trade continuously throughout the day. You'll also notice ETFs usually offer lower fees and passive management, whereas mutual funds give you the simplicity of having that professional driver actively at the wheel.
Now, when you're choosing, I want you to remember the 3 pillars of investing: costs, risks, and returns. And costs matter tremendously. Paying a 1.50% expense ratio, which is just the annual management fee for a mutual fund compared to a 0.10% fee for an ETF, might seem like a tiny drop in the bucket today. But over a few decades, that high fee is literally like a leaky water tank, quietly draining thousands of dollars from your long-term wealth.
Okay, Section 5. Building your portfolio. Let's look at how everyday people actually mix these tools into a wealth-building plan based on their age and goals.
So your portfolio is basically just your personal collection of investments. Let's say you're a conservative investor. Maybe you're nearing retirement and you prioritize safety over hitting home runs. Your mix is going to look heavily weighted towards stability. We're talking maybe 50% in a stable bond fund, 30% in a money market fund, and just a small 20% slice in a stock ETF for a little bit of growth. The name of the game here is capital preservation.
But what if you need a bit more growth?
If you're looking for balance, say you're a business owner saving for a medium-term goal, you'd probably shift to a moderate mix. You might take a larger 50% slice in stock ETFs and 20% in international ETFs for global diversification, while still keeping a comfortable 30% bond cushion. It's a really fantastic middle ground that balances risk and reward.
Now, if you're like Kojo, a young student in Accra with literally decades ahead of you to ride out the market's natural waves, you can absolutely afford to be aggressive. This kind of portfolio is dominated by stocks. Think 70% in a stock ETF, 20% in international ETFs, and just a tiny 10% in bonds. Because you have time on your side, this setup maximizes your long-term growth potential and really lets compound interest work its magic.
Whichever path you choose, building your strategy really comes down to 5 simple steps. Define your goal, determine your risk tolerance, select your investments, invest regularly, and review periodically. And I highly recommend focusing on step 4, using dollar cost averaging. That just means investing a fixed amount, like say every single month, no matter what the market is doing. It totally removes the stress of trying to time the market and keeps fear and greed in check.
As we wrap up this explainer, I want you to keep these 5 golden rules in your back pocket. Start early, invest regularly, diversify wisely, keep your costs low, and think long-term. Following these rules is hands down the best way to avoid those classic beginner mistakes. You know, trying to wildly guess the market, acting purely on emotion, or chasing some crazy, unverified hype on social media. Just stick to the plan.
Ultimately, the absolute worst investment mistake you can make? Doing nothing at all because you're afraid. Sure, wealth isn't built overnight, but it absolutely requires you to begin. So the only question left to ask yourself is this: are you ready to start today, let time do the heavy lifting, and take that very first step toward your own financial independence?